Morning, market chameleons, and happy Friday, last trading day of the week. How are you doing, Dima?
Good morning, Will. How are you?
Excellent. So what's today's topic?
I think what we'll do is take a look at open interest, and we'll see if we could find any type of opportunities, just scanning the open interest, looking for something in particular, because the last time we did it, it kind of led to more discussion. So I'm going to come back to it and just take a look at what's going on in the options, where we see large increases in open interest, and then try to kind of figure out what's going on and taking a look at the board, seeing if anything sets up.
Yeah, and the discussion the last 2 days has been great, actually, because Jake has actually jumped in. I'll put the link, and that's for everyone. We'd love to hear from any chameleon who has a question. So I'll put the Zoom link in the YouTube chat. You'll come over to Zoom and just raise your hand, and we'll put you on with D. So you want to start with the disclaimer?
Yep. So before we get started, everyone, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer.
Great.
Okay, I'm going to share my screen. I think we'll start out taking a quick peek what's going on in the pre-market hours. After that, if there are no questions, I'm going to go on to the open interest. We're going to use a screen and just take a look at what actually happened yesterday and see where open interest has increased significantly, and try to figure out potentially why, and if there are any setups based on the options chain. So right now, these are the pre-market stocks that are moving into pre-market hours, trading in pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. I'm going to come down here really quickly. You see that there's 64 stocks that made our percentage gainers list, 81 on the percentage decliners. So from that, it's kind of a mixed bag, slightly more stocks down than up. Let's take a look at the higher market cap stocks, see if we see a different picture there. So I'm using market cap, 20 billion or higher. This is going to now refilter. We see 24 stocks made the percentage gainers list, 15 on the percentage decliners list. So from that perspective, slightly more bullish bias at the open, but these lists are not very big, relatively small, and it's Friday. So, but one thing I just glancing at it, I'm seeing, Snap and Twitter up in the pre-market hours. Those are reacting to earnings. And I think Pinterest, Facebook also maybe going up in sympathy. So those social media companies look like, at least from the morning, getting bid up. If there are no questions on the pre-market, I'll just move on to the open interest report.
Yeah, head on over to the open interest.
All right, so under options, we're going to go, under options, let's go to open interest analysis. And we got a bunch of tabs up here to go through. I'm going to go by option contract. So this just looks at a specific option contract, and we're going to filter it out based on some criteria. And here we have a bunch of filters here. I'm going to use one of my preset filters, large open interest increase. And I didn't actually, I'm going to push it out as one of the MC presets, so you guys could kind of just drop down and use it as a starting point. But really quickly, I did a simple one here. I'm looking for stocks $10 or above. I have an open interest change. I want it to the open interest on that specific contract to increase by 1,000 contracts or more. And also I put in a relative value, because sometimes 1,000 contracts in something like SPY, or Apple or Tesla might be insignificant. So what I did was create a relative value and compare that to the average daily volume in total. And here I set it that whatever that open interest increase by, it has to be 50% or higher of the average daily option volume. This makes it a significant amount of contracts to, for that specific stock. So now that we use these filters, I could come down and, I got a bunch of them, we got 93 that fit that criteria. So that's a lot of options. We could filter it down further based on if we're looking for something very specific. But right now, I'm just going to kind of leave this up just to look at the data. Maybe we'll use sorting, and if we need, we'll filter it down further. But let's see if we find anything interesting here. And I'm just going to kind of go across the symbol ABCL, $16.03. It was down 3.5% yesterday. And on average, it trades about 1,809 option contracts per day. So that's for that specific stock. And here we see now, this is looking at a specific option. So it's looking at the Jan 2022 expiration, Jan 21st, 2022, 15 strike, and it's a put. So we see it's an out of the money put, $1 away. This option closed at $2.50. It was up 38 cents yesterday. The implied volatility on the option is 68.6. It was up 7.2% yesterday. Yep. And the total volume yesterday on that option was 1,025. So that represents about 56.7% of the average daily volume in this stock. So you could see just this one contract traded a lot, because that's 56% of the average daily option volume if we added up all the calls, puts, expirations, strikes together. So out of this volume, there could be people buying in and selling and closing out. How much did the open interest change by? Okay, that's what we want to see. So here, that's the open interest change. We see that open interest increased by 1,025. So all this, the open interest increase, basically that 1,025 contracts increased in open interest by 1,025. So that's all new positions. It added to the existing open interest. So now we're at 1,147. And what this is telling us is that whatever the volume was yesterday, those trades, they're still committed to it. They didn't trade out of it the same day, and it wasn't closing any previous. It doesn't look like it was closing any previous options. So this is new positions being established on this particular option. And the open interest increase, you could see by 840% from the previous day. And that represents 56.7% of the average daily option volume. So similar here. Total open interest for a BCL, that's not just this one contract, but all the contracts combined is 48,068. So if we just looked at this one line, it represents 2.4% of all the open interest. So not a big concentration right now in one particular option, 2.4%. If we kind of also translate it into, well, how much stock does that represent if it was all in the money at expiration and exercise? So all this open interest, if this went in the money and at expiration exercised, well, we could compare that to the average daily volume in the stock, 1.58 million. So if this was all exercised, that would represent 7.3% of the average daily volume in the stock. So something that could be absorbed, obviously, but we kind of just want to keep a track on a relative basis. What are we talking about? Options contracts, obviously they have, the right to exercise, and based on that, there's a certain amount of stocks that options that will get converted to a certain amount of stocks, and we want to kind of compare that to the average daily volume.
Hey, D, we did have a question from a new chameleon who, Liberty, welcome Liberty. It's his first time on. I did offer him to come over to ask his question. He hasn't come over yet, so I figured I'd ask it. He was asking about, this was something actually Raj brought up on his webinar the other night about Max Payne, stock moving to the maximum pain of open interest. It's called the Max Payne Theory. He just wondered your opinion on it. What do you think about the stock drifting to the largest strike of open interest where options traders are going to have the maximum pain?
So the theory behind it, the Max Payne, is that if a lot of people are, a lot of people are long a particular option, obviously, then there's a lot of people short a particular option. But the idea is that if it goes to the strike, the Max Payne will be to the people on the long side, right? So if it just drifts right to the 15 strike, and then the stock sits there, these options then decay, or all the premium comes out, then on the long side, that creates the maximum pain at exactly the 15 strike, right? Because it didn't cross and they lost all that premium. But on the flip side, for people who are short, the Max Payne will be if it blows right through the 15 strike and just keeps going, right? And then the Max Payne is to the short side, right? So who is it causing the Max Payne to is kind of the idea. I don't know if I don't know if you could really say that this is something that you could consistently rely on. If there's a big open interest, that it's always going to go to the strike, if it's always going to blow through, or kind of be sometimes a little bit blows through. I don't think there's empirical evidence to show that it always does that. Sometimes it just happens to work out that way because, sometimes it'll go right to the strike and sit there. Sometimes it'll blow right through. Sometimes it can trade around it. So I'm not, unless somebody could show me evidence that 90% of the time, this is what it happens, or 80%, or a lot of the time, I don't see that evidence. So it's just sometimes it happens, sometimes it doesn't. So when it happens, maybe people jump on and say, well, this is, it's a theory. But I think it would be hard to really predict because it's also going to, stocks are news driven. You don't know. And there are a lot of people who are not playing the options that will drive the stock either up or down. So I'm not sure if that's really a sound, strategy to rely on. And most of the time, it'll probably the Max Payne, if it's going to pin around the strike, you'll probably see it that day. The day it expires, you'll kind of see that the market is like sitting there. It kind of went to the strike and it's just sitting around there, but I've seen it then float away by the end of the day as well. So,
well, I know, and it's been a few years since we were trading, but if it had happened to us all the time, we would have, I feel like we would have seen, we were trading so many products.
Yeah, we were trading so many products over, decades with options, that have pinned or went right through, never came nearby, that there's no real evidence that there's a consistent sound strategy to work around a Max Payne, but what will happen is if you're looking through a lot of data, you're just going to find situations that, okay, it floated through to the strike. There's a lot on that strike, and then you could create a theory. But
yeah, and it could be actually stock specific too.
It could be sometimes stock specific. It could change, and it'll just depend on like kind of the market conditions too. If things are quiet and and there's not a lot of stock trading, and a lot of the trading is kind of happening mostly from option hedgers, then it's possible that it just kind of gets pushed to a strike. It's possible, but it's hard to predict. I think that would be a very difficult thing to predict because you'd have to know people's positions and what they're doing, and how they're managing their risk and like their overall portfolio. So I think it would be, very difficult. And look, you guys have the data here. The good part is that you don't have to forward test it, right? You have the data in front of you. You could use this, right, to find where there's a concentration of options, coming up. You could pick it by expiration. You have it here, upcoming expiration 2 days or less. You could go find these and test out your theories, right? Write them down, test out your theories. What would you have done and how did it come out? Because when we're talking about trading, a lot of it is about learning, right? It's about observing and learning and using that experience going forward, right? And that's kind of how you want to approach it. If you want to take a theory, start taking the data and and analyzing that data to see if your thesis is sound. Is your thesis good? Before you even try it, right? Because it's much more costly to try it with real money than to actually observe the data, because you have a lot of data here. So instead of trying it on 50 different stocks, you'd have to have a lot of money. You could just analyze 50 different stocks and see, like, this is what I would do. This is my assumption. Was my assumption correct? And keep a record of that. So this way you kind of know from history and experience and use that going forward. So is that?
Yeah, that's super helpful. Thanks, Steve.
Yeah. But do I see empirical evidence that if there's a lot of open interest on a strike that at expiration has to go to that strike? No, it could just drift away. It could go to it or could go blow right through it. There's no empirical evidence that it always does something, or the majority of time it does something. At least I don't see it, not the test that I ran and not from our experience. So hopefully that helps, but we can use it, to see, well, what are people doing and what are the strikes they're going after and perhaps why. And then we could go look at the option chain, because volume, right, and trading starts to push securities to different levels potentially, and it could push them to extreme levels, and it could also present other opportunities to spread off your risk, either by time spreads or vertical spreads or whatever you want. But you could start looking at the board to see if anything is lining up. So, for example, I'm looking at some of these, and these are like longer dated options. Maybe this one is not so longer dated. August 20th, I see, open interest increasing here. And this could be, the shorter dated ones could be something that people are starting to establish positions prior to an earnings, right? So prior to an earnings, you'll see sometimes volumes ticking up. That's typical. And you'll see open interest also ticking up. So this way you could kind of isolate where it's happening and what's going on. And of course, this allows you to kind of start taking a look at those strikes to see if they're getting pushed to, extreme relative values, or even knowing that there's a lot of open interest, for example, on this strike. So I see that in BYD, for example, the open interest yesterday, 1,684 contracts traded. This increased the open interest by 1,520 to a total of 4,876. It doesn't, and I could keep an eye on it to see if that continues to increase going into earnings. But in my head, now I'm getting a sense of, okay, people are establishing positions heading into earnings. I know there's an event, people are establishing, and my assumption is that this is really a bet on an earnings move, right? So, and I'll take a look at where the implied volatility is heading into earnings. But now that I kind of know that there's a lot of people establishing positions, most likely after the earnings comes out, they're going to want to close out of it, right? Because it was really an earnings play. It doesn't look to me like they're playing anything else but earnings. And what that can tell me is the following. I could start making assumptions that if people are going to close out of those positions, right, maybe two things can happen, what I would look for. One is that, depending what the stock does, but one is that a lot of people may just try to sell their positions at the very open and get out. And if a lot of them are doing that, we don't see that order book. But the assumption is if there's a big sell imbalance and the specialist is going to be buying it, market makers are buying it, they're going to open it at a much more reduced implied volatility. So at the open, there might be an opportunity, depending on it, to buy it at a very cheap implied volatility, just because most of those sell orders are front loaded right at the open. And maybe I'd put in a bid at a very low volatility, try to scoop something cheap along with the market makers. Another thing is maybe it doesn't work out, not a lot of sell orders, and it might open up too high, right? Maybe out of these 4,800, maybe the implied volatility ticks down a little bit, but knowing where historically implied volatility, because we could use our data, where it ends up by the end of the day, we might anticipate, hey, you know what, implied volatility is a little bit high. I think that it should be lower, and I think that there are people holding it, so there could be more selling pressure because they don't need it anymore. And based on that assumption, I could maybe even see where it opens and sell some volatility in anticipation of there's going to be more sellers behind me, and the implied volatility will drift to its historical norms. Does that kind of make sense what I'm saying to people? Let me know if there are any questions. So these are the things, by analyzing the data, maybe I could start anticipating some of the, what comes after, just from, historical behavior. And then I could position myself. So hopefully that could, be one example what you might be looking for, something specific. Another thing that came up, I'm going to kind of just sort this by, let's just do by highest volume yesterday. And I'm going to look for something here specifically, like, okay, so I see here FIS, right? It came up twice. So by looking at it, I'm looking at, it came up twice, and I see that the volume was very close together. The open interest also kind of traded close together, and that they're both in the same expiration, and one is a call and one is a put. So in my mind, these two were probably related. All right, this looks to me like it was probably related. And if I'm looking at, I could see that this call is 150. It's above the 146 where the stock closed. This put, it's below the 146. It looks to me like a risk reversal. All right, so somebody is probably buying the call, selling the put, and somebody's buying the put, selling the call. It could be a straddle. I'm not sure. It could be buying both or selling both. We're not sure. We don't get that type of indication right now. All we're being told is that there's multi-leg. So this is part of a multi-leg. So let's take a look at that one. So I'm going to the October. By clicking on it, here we are, October 15th, FIS. And here's the options chain from yesterday. So this is the put, the 140 put. This is the call, 150 call, 4,899. This one, 4,890 on the put. And here I'm seeing that the markets here are very wide. The 150 call, 410 bid, 570 offer. The 140, 340 bid, 420 offer. These are very wide markets. This isn't a very liquid stock when I'm looking at it from that perspective. And when I see this, a wide market, typically I want to be on the side of the market maker. So typically you want to be on the side. How do I know where the side of the market maker is? Well, the closer you are to the bid, that's the closer you want to be buying, because the market maker will be buying right on his bid or a little bit above. The closer you are to the offer, the market maker is potentially selling. So at 570, we're assuming the market maker, 560, because when the market, what you're doing is kind of being on the side of the theoretical edge. All right, unless you know something, and I'm assuming market makers are also have very good research, because we're talking about who are the market makers: Goldman Sachs, Citadel, Susquehanna. You've got the best of the best, that are making this. So they got just as good information as anybody out there. And when I see this, my leaning is, if I decide to do the trade and I think it's good, I'm going to be looking at it from the side of where the market maker was doing it, especially if I'm approaching it from the buy side. So here on the fifth one, and by the way, I'm not telling you what to do. I'm just sharing ideas, just disclaimer. I'm not giving you guys advice. I'm not investment advisors, but this is how I would start looking at it from where do I think my edge would be? And we could open this up and just take a look what happened here. So on here, what I'm seeing is there's a lot of small trades. So it doesn't look to me like there's 1,195 trades traded, a bunch of times. There was a lot of volume. It didn't happen in one big swoop or one big, I'm looking through it right here. I don't see anything. I could sort it by quantity, and one lots. Let's do the biggest one is 17 contracts. So that doesn't look to me, like it was one big negotiated trade, and it looks like it's just been doing it all day. So it's a trade that looks like if you wanted to participate in it, throughout the day, it looks like there's something going on in there that you can. But there it is. You could see how many times it traded. Multi-leg, that means there's another side to this trade. And you could see it's doing it in between, right? So it is doing it in between here. And to me, it looks like it's closer to the bid side. Okay, so to me, it looks like it's closer to the bid side on the 150 call. So why do I see that? I'm figuring it out from the markets, but I'm also looking at the V volatility it's trading. So the average volatility it traded at was 20.83. All right, but look at the implied volatility of the call, 20.8. Implied volatility of the ask side is 26.4. So I'm seeing the implied volatility is trading closer to the bid, right? As low as 18.8, 21.4. So much closer to the bid side, right? So that's where I would probably start lining up and saying, well, look, if we use the mid market as the fair value coming out, where is it, like closer to $5 somewhere there. So if you're buying it around 4, that's already, you've got like 80 cents, 90 cents edge, something like that. So you're right away, you got some theoretical edge off the bat if you could get it on that side. So let's just take a look at the other side of it. So what is this? So this is a multi-leg too. And I'm assuming like these two are related, right? So we see multi-leg, multi-leg, multi-leg. And here, kind of similar situation. It looks like this tightened up, but this looks to me like it's trading closer to the ask side, right? So this to me looks like the market makers were probably coming off, because look, 20.9 is the bid. That's the implied volatility bid. 24.1 is the ask side. And we see it's, 23.6 is the average. So just looking at this, I'm assuming that what the market maker was doing was buying these calls and selling these puts, and somebody's doing the opposite side for about, it looks like about even. Okay, that's my assumption. I could be wrong. They're buying and selling. It's possible that's what's going on. But just the way the options are being lined up, that's what it looks like to me. And maybe I'll think about it. I mean, I'm not sure if I'm crazy about this risk reversal at even. Come to think about it, let me see. they might be buying both. Because this asks seems to me, it's below this and below this. So not totally sure. The way I'm reading this chain, I'm not totally sure. Like I would lean to it's a risk reversal. So why would somebody do? Okay, we're at 9:30. But what we could do is discuss, well, why would somebody be doing the risk reversal? What are your risks involved? And what are the benefits of it? So if we're buying this, selling this, or we're buying this and selling that, what are the different ways that it could be? What are our risks? What are our potential profits?
Maybe we'll look at the risk reversal on Monday.
Or maybe we'll take a look at that on Monday.
Awesome.
But anyway, well, hopefully, guys, stay safe out there. Have a good trading day. Hopefully this was helpful, and hope to see you guys on Monday.
It's always helpful, Dima. They're very appreciative, and they call it a masterclass, D's masterclass. So everyone was super pumped today. Everyone have a great weekend. You